All right, let's jump right in. When you hear about the big geopolitical contests happening today, you're probably thinking about places like the South China Sea or maybe Eastern Europe, right? But what if I told you that the real, quiet center of this new global scramble for resources and influence is somewhere else entirely? Yeah, this new arena is quietly reshaping the future of, well, everything. Energy, technology, and it's forcing the world's biggest powers to rethink their entire game plan. So today, we're talking about Africa's resource scramble. But look, this isn't about the usual political hype or some scary conflict narrative. Nope, we're going to build a clear, simple mental model for a beginner investor. The whole point is to help you understand what's really going on when you see those headlines about a new great game. And we're going to walk through this step by step. First, we'll cover why Africa is suddenly the center of attention. Then we'll look at the two different playbooks China and the West are using. From there, we'll slice through the media hype to see what's actually happening on the ground, pinpoint the real risks for an investor, talk about some common mistakes to avoid, and finally, wrap it all up with a solid framework for how to think about all this. Okay, so first things first, why Africa? And why is this all happening right now? Well, the answer comes down to one of the biggest economic shifts in 100 years, the global pivot to a green economy. The continent holds something like 30% of the entire world's known mineral reserves. And we're talking about the absolute bedrock materials for everything from your EV battery to massive wind turbines. This one simple fact, well, it makes Africa completely indispensable for the future of the global energy transition. And the demand for these minerals? It is absolutely exploding. The World Bank thinks that by 2050, demand for key stuff like lithium and cobalt could shoot up by nearly 500% compared to where it was in 2018. I mean, just look at this chart. That's not a gentle slope. That is a vertical leap. So what's behind this massive surge? It's everything that's defining our future. A single electric car needs 6 times the minerals of a regular one. An onshore wind farm? It needs 9 times more critical minerals than a gas-fired plant. So here's the key takeaway. The green revolution is, at its core, a mineral-intensive revolution. So, with that much demand, it's only natural that the world's superpowers have shown up, and each one has a totally different strategy. So let's break down the two main playbooks, China's versus the West's. On one side, you've got China's approach. It's state-led, it's based on loans, and it's all run through their big state-owned companies. They also have a really high tolerance for political risk. Then you have the West. Their approach is mostly driven by private companies, which makes it way more sensitive to risk. It's also often shaped by things like public guarantees and ESG mandates, that's environmental, social, and governance, which can definitely add layers of complexity. Now, China's signature move is something called the Resource for Infrastructure Swap. A perfect example is the Sycomones deal in the Democratic Republic of Congo. Chinese companies get long-term rights to mine massive cobalt and copper deposits. And what do they give in return? They finance and build desperately needed stuff like roads, highways, and hospitals. It's a long-term play that Western companies, who are often focused on next quarter's profits, find really hard to compete with. But, and this is so important to remember, Africa isn't just some passive chessboard for this game. Not at all. African nations have their own plans, their own vision. Leaders there are actively pushing back against the old models. They're creating frameworks like the African Green Mineral Strategy, which are all about using these resources to build local industries and make sure the wealth actually benefits the continent, not just foreign powers. Okay, this brings us to what I think is the most important part of this entire explainer, especially for an investor. We have got to separate the story the media loves to tell, the hype, from the fundamental reality of how these markets actually work. This timeline right here just perfectly illustrates the disconnect. A big geopolitical headline hits, and boom, the market reacts almost instantly, right? But building a mine, a railway, a port, that takes years. And getting the resources out of the ground and to the market at a massive scale, we could be talking a decade or more. There's this huge, massive time lag between what people feel and what's actually available. So here's the bottom line, and if you remember one thing, make it this. Headlines move stock prices and market sentiment, but only concrete and steel, real infrastructure, can actually move physical supply. Forgetting that difference is probably one of the biggest and most expensive traps an investor can fall into. So if that whole great game narrative can be a little misleading, what are the real risks that an investor should actually be focused on? It's less about some sudden military clash and way more about the messy, complicated, practical realities of getting a huge project off the ground. First up is what's called expectation risk. This is the simple but really powerful risk that a project just doesn't deliver what it promised. Maybe the geological surveys were a bit too optimistic, construction costs go through the roof, or the mine just doesn't produce as much as everyone hoped. In fact, one analysis found that of over 60 big mineral projects in southern Africa, less than 10% had even gotten the financing to start construction. The gap between the hype and the reality is just huge. Second is policy uncertainty. This just means that a host government can change the rules of the game at any time, right in the middle of it. We've seen this in places like the DRC, where they've moved to renegotiate deals and take a bigger stake in projects with Chinese firms. Contracts get rewritten, tax laws change, and what looked like a fantastic investment one year can turn into a money loser the next. And third, you've just got good old-fashioned pricing volatility. The price of a commodity like cobalt isn't set by one mine in Africa. It's set by global supply and demand, by new technologies, by big economic trends. A new battery that uses way less cobalt could completely change the value of a mine that was built entirely around it. These are what people call above-ground risks. And honestly, they are far more immediate and common threats to an investment than some distant geopolitical showdown. We're talking about things like local community protests, or an environmental issue that shuts a project down, or just the simple fact that there's no reliable railway to get the stuff to a port. These are the real-world, on-the-ground challenges that make or break these projects. Understanding these real risks is the key to helping us avoid some of the most common mistakes that beginner investors make when they see those flashy headlines about the resource scramble. So what do these mistakes look like? Well, first, it's chasing a mining stock just because it was mentioned in some news article about China and the US. Second, it's falling for the idea that because a mineral is geopolitically important, any company mining it is a guaranteed winner. It's not. Third, completely ignoring those decade-long project cycles we just talked about. And finally, and this is the big one, it's letting these dramatic stories drive emotional decisions instead of clear, structured thinking. So how do we pull all this together into a framework that's actually useful? Well, the goal here isn't to predict who's going to win this so-called great game. Honestly, that's a fool's errand. The real goal is to be prepared for a whole range of possible outcomes. What that really means is focusing on strategic positioning, not trying to make a specific prediction. It means understanding your portfolio's exposure to these long-term trends, not betting it all on one outcome. You got to see this as a long, multi-decade story, not a short-term trade. And above all else, remember that calm, structured thinking will always, always beat emotional, reactive moves in the long run. And look, I have to be crystal clear about this. This entire analysis is an educational framework. It is a structured way to think through risk and make sense of complex information. It is not, under any circumstances, financial advice. So we'll end with the biggest question of all. With the world's attention now fixed on Africa's incredible resources, will its leaders be able to leverage this moment to build a totally new, prosperous future for the continent? Or will this 21st century scramble just end up repeating the same exploitative patterns of the past? That right there is the multi-trillion-dollar question at the very heart of this new great game.